A purchase price allocation is a process used in financial reporting to allocate the tangible and intangible value of that company on the acquirer's balance sheet. In particular, the objective is to specify and quantify the fair value of goodwill that is associated with the transaction. One of the most common reasons that a financial statement audit is determined to be deficient is because of weaknesses in the purchase price allocation. Accordingly, financial statement auditors pay a great deal of attention to purchase price allocations to make sure that they're done correctly. Purchase price allocations are generally the same whether or not they are done according to US GAAP, UK GAAP, or international financial reporting standards. When companies are acquired, typically a suite of assets goes along with it, and those assets are divided into tangible and intangible assets. Tangible assets are the kind of assets that probably come to mind right away, such as equipment, real estate, finished goods inventory, raw materials inventory, office supplies, and even things like accounts receivable and cash. Intangible assets will include things like software code, customer relationships, customer data, patents, copyrights, trademarks, and finally, goodwill. Goodwill is, in effect, the value that you can't tie directly to a specific asset. The assets that I just described are typically going to be labeled as identifiable, tangible, and intangible assets, which means that they're in some fashion separable, that they could actually be split off from the company and sold as a separate asset. But goodwill is inextricably tied and linked to the value of the company. You can't just sell the goodwill and leave the company intact. It just doesn't work that way. But just because you can't exactly specify the nature of goodwill doesn't mean that it doesn't exist. Rather, it means that the accounting community has decided that there aren't very good tools available to quantify the value of goodwill or the components of goodwill, and therefore they wouldn't qualify as an identifiable, separable asset. Examples of goodwill could be reputation, workforce expertise, management expertise, customer loyalty, operational know-how. Determining the fair value of goodwill often involves two steps. The first step is to determine the purchase price. This sounds simple, but it can be quite complicated in many cases. Most transactions involving a company acquisition do not involve 100% cash consideration. They may involve stock of the acquirer, earnouts or contingent consideration, assumed debt, deferred revenue obligations, and other liabilities. This requires a specialist to quantify the fair value of the economic consideration that was paid. This process, in many cases, can be more complex than the purchase price allocation itself. Once the purchase price has been determined, the specialist can then turn their attention to allocating the actual purchase price. This starts with determining the value of all tangible assets, which may be set as book value or may require the engagement of another tangible asset appraisal specialist. Next, the specialist will determine the fair value of the identifiable and tangible assets, such as the customer data, patents, trademarks, and so forth that I just mentioned. Whatever value remains after subtracting the value of the tangible and identifiable intangible assets is the value of the goodwill. Accordingly, this is called the residual method. Let's take an example. Let's say a software company was purchased for $1,000. It had $100 of tangible assets in the form of equipment and office furniture, supplies, things of that nature. We also have identified intangible assets of $600, including $200 of software code, $200 of customer data, and $200 of copyrights and trademarks. Having identified $100 of tangible assets and $600 of intangible assets, and subtracting those values from the $1,000 purchase price, the remaining $300 is attributed to goodwill. If your auditor tells you that a purchase price allocation is required to complete your financial statement audit, the process for completing the purchase price allocation is as follows. First, you retain an independent valuation firm to prepare the analysis. Generally speaking, your audit firm is prohibited from performing this valuation analysis because it would put the firm in the position of auditing its own work. Accordingly, once you retain the valuation firm, they will then perform the purchase price allocation. At that time, they will submit the purchase price allocation to you, and then you will submit it to your financial statement auditor, whereupon the auditor will review that work. There may be several rounds of questions and comments that go back and forth during the purchase price allocation review process, and this is completely normal. At the end of the process, the auditor will determine whether the conclusions provided in the purchase price allocation are reasonable and sufficiently supported for inclusion in the financial statement presentation. At this point, the fair value of goodwill will be presented on the balance sheet. In this case, $300 of goodwill will appear in the audited balance sheet of the acquiring company. I mentioned that purchase price allocations are one of the most commonly cited sources of weakness in a financial statement audit. This generally occurs for one of three reasons. First, the valuation specialists themselves is inexperienced. They may not have performed many purchase price allocations before, and they don't know all of the nuances or even all of the specialized techniques that are required to perform a credible purchase price allocation allocation and produce a credible and reliable opinion of value on the value of goodwill. The second most common pitfall is poor documentation. The valuation specialist may produce a perfectly reasonable and reliable valuation conclusion, but if it's insufficiently documented, then the auditor will not be in a position to accept it. It's important to remember that the auditor's job is to produce reliable financial statements that conform to generally accepted accounting practices. One of the key elements of ensuring this conformity is to make certain that proper documentation of all the inputs into the financial statements are reasonable and supportable. The third most common pitfall is where personal conflicts arise between the auditor, the specialist, and the client. As I said earlier, it's entirely reasonable for there to be significant back and forth between the auditor, the client, and the valuation specialist. In the heat of the moment, as you're racing towards finishing the process to present your audit and meet your deadlines, things can get heated. Personal feelings can enter into the discussions, which do nothing to help the process along. The best valuation professionals adopt a collaborative posture rather than one of being defensive. Ultimately, the goal of the purchase price allocation is to translate an acquisition into defensible financial reporting. The goodwill valuation must survive scrutiny from auditors, regulators, and sometimes investors or courts. Of course, the numbers matter, but the documentation and professionalism that were utilized in arriving at that number are equally as important. If you have a potential purchase price allocation need or just have any questions about the process, contact High Score Strategies to schedule a consultation.